Okay. Come on. All right, let's look at this. All right, so chapter 1, introduction. Okay, here we go. So business, we know what a business is. We talked about that. Different types of businesses. We have service businesses. So like Delta Airlines, the service of transporting people and goods, that's a service. Walt Disney Entertainment, merchandising. So the biggest merchandiser that you think of is usually Walmart or Amazon. And what a merchandiser does is they buy product that's already been manufactured, mark it up and sell it for a profit. And then, of course, you have manufacturing business. And what they do is they buy raw materials and apply labor and factory overhead in order to produce a finished product that they turn around and sell to the merchandisers. Merchandisers sell that to the consumer, and the consumer consumes the product. Okay. Accounting, the purpose, it's an information system. So we can take everything that happens in a business, every transaction, right? What's a transaction? The exchange of goods. Remember, in accounting, we have that business entity concept that says that the business is separate and distinct from the owners and from all outsiders. So therefore, any transaction or exchange of resources between the business and the owner, for example, if the owner puts money into the business, that's a transaction. If we buy or sell in the economy, that's a transaction. You are exchanging resources with some person or entity outside of the business itself. So accounting is a language for being able to record those transactions in such a way that we're able to produce financial statements from it. So remember, you're learning a language. It's kind of like a shorthand of how do I say this in a way that makes me able to produce a set of financial statements from it. Useful information that a business, whether you're talking about the insiders, like the managers and the officers of the business, or outsiders like creditors, investors, potential employees, potential customers, potential suppliers, the U.S. government. So any stakeholder that's interested in the performance of that business can read those financial statements. Okay, and then of course we have managerial accounting. That's for internal accounting for managers and officers to use. And they are employed in private accounting. So public accountants like myself, a certified public accountant, works for a lot of different companies. A private accountant, and I used to be one when I worked for the Fork Empire. I was a private accountant. I worked for one company. So I didn't go get the CMA, Certified Management Accountant, which is the highest levels you can get in managerial accounting, because my goal was to get a CPA. So at that time, I was working toward receiving my CPA license and did while I was working for that organization. So private accounting is what we call managerial accounting, because you're working for one organization and you're helping them to manage their resources. And then public accounting, you're working for lots of organizations and you're interested more in external reporting and internal reporting. So as a CPA, I have the opportunity to advise clients on managerial type of accounting and finance as well. And there's financial accounting. Of course, we need to be ethical, right? As a CPA, I have to get, 2 hours of training in ethics every 2 years when it's time for me to renew my CPA license. That's just in case I forgot how to be ethical. They want to make sure that I remember that. And when you pass the CPA test, you have to take an ethics test before they'll give you your license. Of course, most CPAs cheat on that. They just borrow somebody else's test, and which don't really sound ethical, does it? Anyway, so ethics is important just because in the United States, the primary source of capital for large organizations, corporations, is the U.S. Stock market. And of course, the stock market only works if the information is useful and relevant and accurate so that financial statement users, investors, can rely on that information to make good decisions about which companies to invest in. So the U.S. government, specifically the Securities and Exchange Commission, which is a part of the U.S. government, tries to maintain that information and make sure that what is being reported by publicly traded companies is accurate and timely and relevant. So they actually are in charge of the entity that creates US GAAP. So, and we call that entity the FASB, Financial Accounting Standards Board, FASB. So the SEC, the Securities and Exchange Commission, which is part of the US government, is able to dictate to the FASB, the FASB, Financial Accounting Standards Board, how to promulgate GAAP, what works and what doesn't, what's good information for financial statement users and what isn't. Does that make sense? So that's what makes the stock market work, is CPAs, certified public accountants, are the watchdogs for the U.S. capital markets. And without us, then we could have mass cheating. Of course, we have cheating anyway. That's why we have to study auditing class. So that's in auditing class, that's what we do. We study crooks and how to catch them, because it still happens, even though we try our best to prevent fraud in financial reporting. The SEC, that's why we have to have the SEC, because it's their job to prosecute fraudsters, people that are fraudulently reporting their financial information, and also insider trading. So do you know what insider trading is? That's when somebody inside the corporation uses information that they know because they are related to that entity, working for it, either as a customer, supplier, employee, board of directors, whatever, and they trade on information that they have learned in that capacity in order to get an advantage in investing in the stock market. And even though that sounds counterintuitive, right? If I know, for example, if I own $10,000 worth of stock in a particular corporation, I work for the corporation, and I know that bad news is coming down the pike, and I can't sell that stock before that news becomes public, because that's an unfair advantage. Does that make sense? So in order to be able to sell that stock, I have to wait for that information to go public when everybody else knows it at the same time. It's like say and go, right? So if you're running a track meet, and everybody's at the starting line, nobody can trade until you say go. Nobody can trade until that information becomes public. And that's why it's called insider trading. And that's unfair advantage, and that's illegal. So the SEC will prosecute insider trading. Make sense? It's their job to protect investors. And the only way to protect them is to make sure that they have the same opportunity as everyone else in the market. Okay, so some business frauds, and we studied these in the accounting class or in the auditing class. And of course, we talk about them as we go along because they're certainly relevant to what we're learning. For example, I talked about Enron in my advanced accounting class yesterday because it's certainly relevant to what we study there, because their fraud had to do with buying other companies, and that's what we learn in advanced accounting class. Okay, so we talked about ethics. Okay, and of course, during 2001, that was when Enron and WorldCom happened, and they, at that time, were the two largest bankruptcies in U.S. histories. And investors lost billions of dollars by investing in those companies, and because we did not have the stricter requirements that Sarbanes-Oxley brought to us in 2002 when it was passed, that's why those investors lost all that money, is because I guess the regulations were a little looser. And so Congress, after those things happened, they said, well, that's not going to happen again. So they quickly created the Sarbanes-Oxley Act. That act was named for, I think Sarbanes was a representative and Oxley was a senator or vice versa. And so the two of them either started this act and got it written and passed, and it was signed into law in 2002. And the Sarbanes-Oxley Act created the PCAOB, the Public Accounting Public Company Accounting Oversight Board. So this is actually the people that watch the watchers. So they audit the auditors to make sure that they're doing a good job and that they are being independent of their clients. Because one thing that happened during the Enron WorldCom debacles was the accountants kind of got in bed with their client, and instead of auditing the client, they kind of helped them along. So that's a big no-no in accounting. Of course, we have to keep objectivity and independence from our client in order to be effective auditors. So ethics is important in accounting. Some career paths, and these numbers are probably, well, they are old because I think this textbook is probably at least a couple of years old. So here's some opportunities in accounting. So a bookkeeper that's not even certified, starting salary. And of course, this is going to be average across the nation, I'm assuming. Let's see, there's an asterisk, wonder where this information comes from. Average salaries round to the nearest thousands comes from the 2017 U.S. Salary Guide. So a bookkeeper on average makes $40,000, or did in 2017. Of course, that was 7 years ago. Payroll clerk, 40,000. General accountant, 51. Cost accountant. Now, cost accounting is my thing. I love cost accounting because we study, and that's actually your 331 junior level course, and we study manufacturing, which is one of my faves. If I come back as an accountant next time, I'm going to be a cost accountant, not a public accountant, because I just think it's so cool to work in a factory and measure the cost of manufacturing products. So one of my favorite things to do. Okay, internal auditors. So oftentimes these are banks have internal auditors, and large corporations have internal auditors. And what they do is they actually work for the board of directors. They're looking for fraud in financial reporting and protection of assets within an organization. So they report directly to the board of directors. So if the CEO is cheating, for example, it's the internal auditor's job to catch him and report that to the board. So kind of a cool job, but you're always the enemy. So I've actually had friends that were, and students that became internal auditors. So they make a lot of money. They're kind of important, but they're feared. So they walk into a room, everybody kind of cringes because that's the popo. Okay, information technology auditor. This is kind of cool. So if you're into computers, you might want to be an IT auditor. And of course, everybody knows, as I've said before, I was a computer programmer in one of my lives. So I write software as well. So I think that would be kind of cool. Okay, and of course, CPAs, that's average salaries in large firms. $68,000 is the average. And of course, that's not a partner CPA. That's just a CPA working for a large firm. Mid-sized firm, 61,000. Small firms, 56,000. And of course, if you make partner, it's going to be significantly higher than that. And of course, if you own the company, then it's going to be significantly higher than that. Okay, so what we're going to be studying are the rules of accounting. In order for us to learn a language, we have to know the rules, and we call those rules GAAP. And of course, because every country can choose its own GAAP, we have to say U.S. GAAP. So the United States GAAP is what we're going to be studying. GAAP is Generally Accepted Accounting Principles, GAAP, Generally Accepted Accounting Principles. So the rules of accounting is what we're going to be learning. And there's the FASB, as I mentioned earlier, and the SEC. So I got a little bit ahead of myself. So there's a little slide about that. And these PowerPoints stay out there all semester. So if you want to go back and review this, you can do that. But I see some of you taking notes, and that's awesome, because remember, that's one form of learning. Kinesthetic learning is to write things down. There's muscle memory, and then of course, there's oral. You're listening to me. Visual, you're seeing it on the PowerPoint, and then kinesthetic, you're actually writing it down. So you've got that read, write, and that kinesthetic going on. So you're actually using probably all four forms of learning, and that's an opportunity to remember all this stuff. Okay, a counterpart to the FASB is the IASB. So in the United States, we still use U.S. GAAP. Some countries have adopted the International Financial Reporting Standards, and the goal of the there's a conglomerate of SECs for all the different countries, well, several different countries, and they decided that they wanted a single set of financial rules of GAAP for the whole world. So they wanted an international financial reporting system, IFRS, International Financial Reporting System. So they got together and wrote a set of standards. They created the IASB, the International Accounting Standards Board, and they wrote a set of standards that could be used by all countries. And of course, the United States, as usual, the ugly Americans, we think that US GAAP is the greatest system in the whole world, and we don't want to adopt the International Financial Reporting Standards, the IFRS. So the FASB and the IASB, those two boards are constantly working together to try to converge the two systems and to find something that the United States will accept, that the FASB and the SEC will accept to be used by all U.S. companies. So currently in the U.S. stock market, we allow companies to use either U.S. GAAP or the International Financial Reporting Standards. So you can do either. So if you have a foreign company that is listed on the U.S. stock market, they can report their financial statements in International Financial Reporting Standards. And that's only happened, well, they used to, they could report with international standards, but they had to show a reconciliation to US GAAP that showed if I had used GAAP, this would have been what the results would have been. Because the standards are different, you can actually get a different net income and a different statement of financial position under the two different standards. So they did away with the reconciliation. So they're somewhat closer to converging the two systems. But in my opinion, they've been at this for over 40 years. They're never going to converge because they're just too different. For example, one thing that's majorly different is that in US GAAP, and we'll talk about that many times, we have the historical cost principle, which means that all fixed assets are recorded on the balance sheet at historical cost. And US GAAP has been, they've complained about the fact that US GAAP, they criticized it for holding to that historical cost standard. But the reason that US GAAP does is very important because we have to have auditable financial statements. And in order for it to be auditable or verifiable, a CPA ought to be able to determine that the value that which the fixed assets are recorded on the balance sheet is accurate. So if it's recorded at historical cost, it's pretty easy to verify. So if I record a piece of equipment on my balance sheet at $50,000 and a CPA wants to verify that that's reported accurately, it's easy to go back to the documents. You either wrote a check or you did some kind of a bank transfer, or you borrowed money at the bank and the bank wrote a check to the dealer to purchase that piece of equipment. It's easy to verify. So when it's time to do the financial statements, of course, everything's recorded at historical cost. So therefore, when an auditor comes in to audit the books, it's easy to verify that those numbers are accurate. Under the International Financial Reporting Standards, because they're trying to take care of all companies in every country in the world, they allow assets to be revalued to the current value. And of course, that's important in countries like South America, where the inflation is double digits. Now, in the US, we try to control the inflation between 3 and 4%. So it's not a significant increase each year for an asset that if it only goes up 3 or 4%. But if you're in South America and the inflation rate is running at 12 or 15%, that's a little bit more significant. So that's why the International Financial Reporting Standards allow that difference, and US GAAP doesn't like it. Okay, so the assumptions in accounting, of course, we use the US dollar. I guess some people would like us to use some kind of cryptocurrency or something, but so far for accounting, we use the US dollar as our monetary unit. Time period, so we measure time, how much money the company has made during a period of time. There's the business entity assumption, as I mentioned earlier. The business is separate and distinct from all owners and all entities outside. Different forms of business that we can have in accounting. Of course, a sole proprietorship or a proprietorship, sole, S-O-L-E, meaning single owner. So in the United States, because we have a free enterprise system, anybody can hang out a shingle and suddenly they're in business. Okay. So, if you want to be Joe's Welding, Joe can just take a sign, hang it out. He's in business. He's a sole proprietorship. If Joe and his brother would like to go in business and start a welding or a mechanic shop or whatever he wants to do, they can say, hang out a shingle and they're a partnership. No paperwork is required. It's not a separate legal entity. It's just a small business. The problem with that is they have unlimited liability. They have no liability protection should the business get sued. But of course, they're just a small business. It's just, just two partners. They're related and they kind of look out for each other's back, right? But when you get to be a larger entity with more and more owners, more likely that somebody might make a mistake or maybe even some kind of intentional tort, which is what we call fraud, and hold the other partner responsible for that. So in order to have protection for owners that want to go in business with lots and lots of different people, and of course, the stock market is all corporations. So therefore, we need to have liability protection for those people that invest in the stock market. Otherwise, you're not going to put your money in the stock market, right? So if you own a piece of Microsoft and Microsoft gets sued and you're suddenly responsible to pay off some debts for Microsoft, then you're not going to buy the stock. So in order to incentivize people to buy stock in the stock market, the government gives liability protection to stock market investors. The only thing that you can lose is the amount you have invested in that stock. So it's called limited liability protection. So if you're a sole proprietorship or a partnership, you're fully at risk for the debts of the business. But if you own stock in an LLC or a corporation, then you are not responsible for the debts of the business. The most that you can lose is the money that you have invested in that business. Okay. And there are other advantages and disadvantage in your entity choice. So, for example, if you choose to be a sole proprietorship, you're going to have to pay self-employment tax, 15% on the net profit, as well as income tax. If you choose to be a partnership, same thing. You're going to have to, each partner has to pay self-employment tax and income tax. LLCs, they're taxed exactly the same. There's no tax advantage to being an LLC. Corporations, however, currently pay a 21% flat tax. So if you're in a 37% tax bracket on the personal level and you want to keep your monies reinvested in the corporation at a lesser rate, you might want to be a C corporation. So you're only taxed at 21%. So there's an advantage there. However, the monies coming out of a C corporation do get double taxed. So the corporation pays 21% tax. When those dividends come out to the owners, then there's an additional tax on those dividends. So there is double taxation. So I usually advise my clients, if they're a small, closely held company, not to be a C corporation. Unfortunately, the U.S. government gave us an option on that. We can have an S corporation. So if a company has less than 100 shareholders, they can elect to be taxed as an S corporation, which kind of gives you the best of both worlds. You are, and all the people working for the business are employees of the business. So the business pays the self-employment tax for you. And the income tax is just taxed at the owner's current tax rate. It flows through just like a partnership and a sole proprietorship does. So there's no double taxation with an S corporation, but yet you still get the limited liability protection. So I usually tell my clients that if they're thinking about starting a business and they're going to have payroll anyway, S corporation is what makes sense. That way you can control the amount of Social Security tax that you're having to pay in, as opposed to a partnership or a proprietorship. Whatever the profit of the business, you have to pay that 15% self-employment tax on the whole amount. Okay, makes sense. So liability protection, the number of shareholders, and tax situation is what's going to control what type of entity you want to be. All right. Of course, in accounting, we assume that a business is going to continue in business, that it will be a going concern, that it's not going to go out of business, go bankrupt. It is a going concern. So we assume that. Of course, in auditing class, we studied the fact that when we audit a company, we have to test to see if we think they will be a going concern. Because the CPA, when they issue their report on those financial statements after they've done the audit, if they think the company is not going to make it, they have a responsibility to report the fact that they have doubts as to whether this company will make it. Okay, 4 principles for measuring. So the measurement principle requires that amounts to be objective and verifiable. So as I said earlier, that's why we have the historical cost principle, is that makes the value of those fixed assets more measurable and verifiable. And there's the historical cost principle. So I mentioned that earlier. Historical cost principle says all fixed assets have to be recorded on the balance sheet at historical cost. We never get to revalue them to current value. Okay, revenue, everything that the company has earned or received from providing services or selling goods to customers. Revenue recognition principle tells us when revenue has to be recorded, which is as it's earned. And then later in more advanced accounting classes, we'll talk about different revenue recognition principles because of the way that some entities have to do their business. For example, if you're developing a subdivision and you're building lots of houses, it may be a year or more before you actually earn any money because you're in the process of developing. So we have some different principles that allow us to earn income as we go. So we'll study that, as I said, in more advanced classes. But at this point, we know that revenue is everything that the company earns, and we earn it as soon as the process is completed. So if it's a service business, it's when the service is completed. If it's a sale, it's when the product has been delivered. All right, expenses, everything it costs us to generate that revenue. Of course, we recognize expenses as they are incurred, or when we actually incurred that in the process of generating revenue. The accounting equation, everybody knows this by now, right? Assets equals liabilities plus owner's equity. And what that should tell us is in order for a business to function, it has to have assets, right? We have to have cash to pay bills with. If we are in the process or in the business of selling stuff, we have to have inventory, right? Which is an asset. And everything that the company has that is available for sale in the ordinary course of business, that's what inventory is. Have to have money to buy inventory. If we're a manufacturer, we have to have raw materials, have to have money to buy that. If we are in manufacturing, we have to have some equipment. We have to have a place to work. So sometimes a company will buy real estate, sometimes they rent it. We have to have equipment that we use in a service business. For example, I have to have lots of computers and copiers and calculators and those kind of things. So you have to have money to buy assets in order to be in a business. And then, so that's your assets on the left-hand side of the equation. On the right-hand side is where does that money come from? We either had to borrow it, which is a liability, right? So we can finance with debt, or we can finance with equity, which means it came out of the pocket of the owners. Okay. So when I started my business, I didn't borrow any money because I was making good money. I saved up. And then when I started my business, I had capital to contribute into the business. So I started with no debt. But of course, I'm a service business, so you don't have to buy that much stuff. Now, if you're in the business of manufacturing, then you have to buy lots and lots of equipment. You have a huge capital outlay. And so sometimes you have to borrow money in order to do that. So it just depends. Okay, so assets equals liabilities plus owner's equity. So every company needs assets, two ways to finance those assets, either with debt or with equity. Okay, we talked about a business transaction. Here's some examples. And I think we looked at some of these. So Chris Clark, remember that business entity concept. Chris takes the money out of his personal bank account, transfers it into the business in exchange for owning the stock in the business. So that's a transaction, right? Even though he's the owner, business entity concept says that's a transaction. So he transferred money out of his bank account into the company's bank account. So now what does the company own? It owns a bank account with $25,000 in it. So that's an asset, right? So the money that they, the bank account has future economic value. So that's an asset. And where did it come from? We didn't borrow it from outsiders. It came from the owner. So it's capital or it's common stock or capital stock. So it increases owner stockholders' equity. Does that make sense? So that's your very first transaction. Increase cash, increase owner's equity. The owner simply puts the money into the company's bank account. First transaction, increase assets, increase owner's equity. Second transaction, Net Solutions, the company decides to buy some land. And of course, they've got $25,000 in the bank. The land's going to cost them 20. So they spend some of the cash and buy some land. That's a transaction, right? They gave cash in exchange for land. They exchanged resources with somebody outside the business. So, of course, in accounting, we're learning how to record that in such a way that we can make a financial statement from this journal of all the transactions that happened to the business. So what happened? We reduced cash. So those assets went down because cash is an asset. But then another asset, land. Is land an asset? Yes, it has future economic value. We can buy it and sell it in the economy. So that is also an asset. So one asset went down, one asset went up. So assets remained constant, right? One went down, one went up. Liabilities remained constant. Owner's equity remained constant. So we're still in balance. So now we have $5,000 left in cash. We own $20,000 worth of land, and our owner's equity is still $25,000. We're in balance. Okay. All right, next, a liability created by purchase on account is called accounts payable. So remember, liabilities is anything that we owe. So any account that says payable is a liability. The payable account that we use most often is accounts payable. That's where we record the fact that we owe for our day-to-day bills. So the electric bill comes in, that's accounts payable until we pay it. We buy some supplies. Anytime we go to a business, say, put that on my account or put that on my tab, right? That's accounts payable. That means I'm probably going to pay you next month. Typically, accounts payable is paid within 30 days during the next month. So it is a short term or a current liability. Does that make sense? The one that's most often used, more transactions through accounts payable than any other liability account. Okay. Also, we have prepaid expenses. We need to understand what that is. So it's an asset because it has future economic value, but we're never going to sell it. So it's going to be an asset that will be used up. So the definition of a current asset is that any asset that's going to be sold or turned into cash or used up within 1 year. So this is also a current asset, but it's never going to be sold. It's going to be used. An example is supplies. We buy supplies and we put them into the closet. It's never going to be sold. It's going to be used up. So that's why it's called a prepaid expense. The using up of an asset is an expense. Exactly. So when those supplies get used up, they become an expense. That's why it's called a prepaid expense. It's never going to be sold. It will turn into an expense. So it's been paid now. It's still an asset. It will be used up. It will become an expense. Okay. So that's what we call prepaid expenses. Another one is insurance. Because remember, when we buy an insurance policy, it has future economic value, right? If I buy an insurance policy on that a delivery truck or a semi truck that I'm using to deliver product, if I wrap that truck around a tree, that policy has a lot of economic value, doesn't it? Because it's going to pay me for that truck, or pay the creditor, whomever owns that truck is going to get paid by that insurance policy. So insurance is an asset, and it is not going to be sold. It will be turned into an expense. So over time, that insurance policy will turn into insurance expense. So it's also called a prepaid expense. Okay. And then next thing that happened, Net Solutions did some work and they got paid. So doing work and getting paid, we earned that money. Anytime we earn money, we call that revenue. Good. Anytime we earn money, it's called revenue. You need to get used to these terms. Going to use these terms a lot. So this is just laying the ground floor, right? We got to learn all these terms and what they mean. And of course, one way you're going to do it is by doing those online quizzes. That's just going to repeatedly keep asking you different questions about these terms so that you get that in your head. That's why I have you do those online quizzes. And they're rather large. They're going to take a little bit of time. So fortunately, you don't have to sit and do the whole thing at one sitting. You can, if you have a few minutes, you can answer a few questions, go about your business, come back later, continue that same quiz until you submit it. You still have the opportunity to come back in and finish that quiz. And then when you've answered all the questions, you submit it, see what your grade is. If you don't like it, you can take it again. Okay. And of course, the next time that you go through it, you've already answered the questions once. So more than likely, you're going to be able to go through it rather quickly. Okay. And just concentrate on the ones that you missed. And that is great because learning, of course, repetition is important in the process of learning. If you keep being self-assessed, so you keep asking yourselves those same questions, then that gives you the opportunity to, that repeated, bringing that back into the forefront of your memory is going to help you to learn that material. So that's the purpose of the online quizzes. And I don't mind if you work together on them, because working together and discussing those things, that's going to be a form of learning too. So if you can grab a buddy and say, hey, let's work on these questions together. Maybe you know some of the answers, your buddy knows some of the answers. That's just another opportunity to learn. So that's fine. Okay. All right. So we earned money and received it in cash. So what happens to cash? It goes up, right? So assets increase because cash is an asset. What about owner's equity? So remember when we broke down owner's equity, it has had a contributed portion, which we call capital. In this case, because we're talking about a corporation, our capital account is called common stock. So that's the capital account. That's the contributed portion that the owners put in out of their pocket. The other side of the owner's equity is the portion that was earned by the business. It's called retained earnings. Remember the definition for retained earnings? Everything that the company has earned from the beginning of its life until now that it has not paid out as a dividend. That's the full definition. And if you'll remember the whys, you can rebuild the whats, right? So why is it called retained earnings? It's everything that the company has earned, revenue minus expenses. That's what we earn, right? The net profit, revenue minus expenses. That from the beginning of its life until now, that it has not paid out as a dividend. What's a dividend? That's when we pay a return back to the owners for the use of their money. So Chris put $25,000 into this company. So eventually he's going to want a dividend to be paid back to him for the use of his $25,000. So that is monies that was earned that is no longer retained. So in order to calculate retained earnings, we add in everything we've earned and subtract out anything that was paid out as a dividend. Okay. All right. So increase cash, increase revenue, which increases owner's equity. Okay. Remember when we wrote out the account equation, okay, owner's equity broke down into the portion that's contributed and the portion that is earned, retained earnings. Retained earnings came from revenue minus expenses. So that's what we earned, right? That's our net profit. Or of course, if the expenses are bigger than the revenues, it's a net loss, right? So this is what the company has earned minus dividends, which is what we've paid out to the owners for the use of their capital that they contributed. Does that make sense? Okay. So accounting equation, of course, this is the extended version. So stockholders' equity, when we earn revenue, that's a plus. It increases retained earnings, which increases owner's equity. Okay, does that make sense? So these are pieces and parts of owner's equity. These are pieces and parts of retained earnings. So when revenue increases, it increases owner's equity, it increases retained earnings, which increases owner's equity. Same thing with expenses. When we pay out expenses, because it's a reduction in retained earnings, it reduces owner's equity. So when we put it on here, it's going to be a negative under stockholders' equity or owner's equity, same thing. Okay, so fees earned. That's a revenue account. If we're Walmart, what do we do to make money? We buy crap from China, mark it up, and sell it at a profit, right? So how do we earn money? We sell crap. All right. So sales is the revenue account for Walmart. Uh, I own an apartment building. So when I rent those apartments out, that's rent revenue. I'm making money just because people are renting those apartments. All right. So that's another form of earning money. Interest revenue, I have some monies at the bank that's earning interest. So whenever the bank pays me interest, that's another form of earning money, interest revenue. So these are all different types of revenue. So if I was a doctor's office, then my revenue account might be called patient revenue. Because I'm an accountant, my revenue is called fees earned, okay? Because I charge a fee for my services, okay? Then we need to discuss accounts receivable because in accounting, we record revenue as it is earned. Sometimes I finish a job, but I don't get paid right away. People owe me money. When customers owe money to the business, that's called accounts receivable. So I've done a job for somebody and they haven't paid me yet. Put that on my tab, right? So when we said accounts payable, if I go to a store and I tell somebody put that on my tab, that's accounts that I owe to that person. That's accounts payable. If a customer comes to me and says put that on my tab, that's accounts receivable. All right, does that make sense? So accounts receivable to me is accounts payable for someone else. And the opposite is true. So payable for me is accounts receivable for someone else. All right. So they're opposite sides of the same transaction. All right. So accounts receivable is an asset, right? Can't touch it, right? It's not a tangible asset, but it's an asset because I own the right to collect that money. Does that make sense? So accounts receivable is on the balance sheet as an asset. I own the right to collect that money. And if we're going to record revenue as it's earned, we have to have accounts receivable because a lot of times people don't pay when they receive the services or the goods. They're going to pay later. So we have to record revenue as it's earned, even though we have not collected it. So therefore, we've created an accounts receivable. All right, and we'll look at transactions on that. I told you what expenses are. That's the cost of earning that revenue. And sometimes we don't pay expenses as they're incurred. Remember, in US GAAP, we record them as they're incurred, even if I haven't paid it yet. So if I need to record the expense, but I haven't paid it in cash yet, I have to record the fact that I owe it. So I'm going to report an accounts payable. All right, so let's look at another transaction. So it says net solutions paid. What did we pay it with? Cash, right? That's our monetary unit in US GAAP. So we paid it with cash. We paid wages, rent, utilities, and miscellaneous. These are all expenses, cost of operating their business. So they had to have help. So they paid wages to employees. They rented a place to do their work. So that's an expense of doing business. Had to pay utilities on that building. And then we had other miscellaneous stuff that we paid, just cost of doing business. Okay, so cash goes down, right? So assets are reduced. And because expenses reduce owner's equity, it reduces retained earnings, which reduces owner's equity. So we end up with a negative under owner's equity and we're still in balance. All right, another transaction. Let's see, paid creditors on account. So we previously bought some supplies on account and now we're going to pay them. What do we pay them with? Cash. So cash goes down. And then accounts payable was how we recorded it before because we owed for that product, whatever we received. We owed for it. Now we're paying that debt. So when the liability goes down, at the same time as cash goes down, so assets go down and liabilities go down. Does that make sense? So $950 reduction in assets, $950 deduction in account in liabilities. Okay. Make sense? It's because we paid that debt. So think of liabilities. This is what we owe. So now that we paid part of it, that makes liabilities go down. All right, next, determine. So remember we bought those supplies, put them in the closet, and we said they're going to get used up. So now it's the end of the month, and it's time for us to look to see, did we use up some of those supplies? Because when they get used up, they become a what? Assets become expenses. So we went to the closet to see if any of those supplies are still left. And we counted them. And it says that at the end of the month, we still had $550 left. So what that means is that $800 of them got used up, right? So that means we need to recognize an expense to the tune of $800. So how much is left in the closet? $550. So we need to go to the supplies column and get it down to $550. So we're going to record the fact that some of those supplies got used up. And so this is just the language. How do you say that with numbers? And this is how you do it. Okay. How do you say that with numbers? You know, we could write out supplies, $800 worth of supplies got used up. But in accounting, we learn how to write that out in a way that makes it us able to produce a set of financial statements from it. So that's why we have to learn this shorthand kind of language, bookkeeping. Okay. So supplies went down and expenses went up, which makes owner's equity go down, right? Because expenses is a negative under retained earnings, which is a negative under owner's equity. Okay. So that makes owner's equity go down. All right. Then they paid a dividend to Chris. He needs some money back out of his money. So they paid him a dividend. What they pay it with? Cash. So cash goes down by $200. Dividend is a negative under retained earnings, which reduces retained earnings, which reduces owner's equity. So owner's equity went down by $2,000 and assets go down by $2,000. Okay, and there's the summary. That's all the transactions for the month. So we just add all those up, and there's what's left. There's your assets that are left. There's your liabilities that are left. There's your common stock. Of course, it didn't change. There's how much you paid out in dividends. There's your total revenue that you earned. There's all the expenses that you paid out. So we just summarized that. So we just took what happened and we put it in a form so that we can summarize it and we can make a report out of it. Yes, sir.
Is it something that's competitive common stock doesn't change?
Right. So the only way common stock is going to change is if we buy it back. If the company buys the stock back, and actually that's not even going to change the common stock account. It's actually going to be a separate account called treasury stock, even if we buy it back. So common stock almost never goes down. Now, if we issue more stock, so maybe Chris decides he wants to sell some stock to somebody else, then that's going to make it go up. But it very rarely ever goes down. Good question. Okay. Talked about all that. Talked about that. Let's see. Yeah, talked about that. All right, there's just another example. Okay, and then the financial statements that we're going to produce. So we've learned about transactions and how they affect the accounting equation. And of course, we've learned this. If you've had my 270 class, you've done a lot of financial statements, haven't you, Zach? Okay, so the next step after we have that summary of all the transactions, we produce a set of financial statements: income statement, statement of owner's equity, balance sheet, and statement of cash flows. And there's what's on them. Income statement has all the revenues and expenses. Statement of stockholders' equity shows the change in stockholders' equity. Who can remember that formula? How do you calculate ending stockholders' equity? Zach, do you remember the formula for calculating ending stockholders' equity? Ending retained earnings. So you take beginning retained earnings plus net profit minus dividends equals ending retained earnings. So you'll remember that after you've done a few statements of equity. And of course, the balance sheet has assets, liabilities, and owner's equity, and it balances. That's why it's called a balance sheet. All right. So it shows the accounting equation. And of course, statement of cash flows. Remember, we said that on the income statement, all revenue is recorded as it's earned. So it may say $100,000 worth of revenue, but we haven't collected it yet. Okay. Expenses are recorded as they're incurred. So it may say $90,000 worth of expenses, but we haven't paid it yet. So we say that the income statement is reported on accrual basis. accrual basis, not cash basis. If it was cash basis, we would only put revenue on there as it is earned, or as it's collected rather, and we would only put expenses on there as they're paid. But in order for us to get a true picture of how much money the company made, revenue has to be recorded as earned and expenses have to be recorded as incurred, even if there's no cash that's changed hands. Does that make sense? So we say the income statement is on accrual basis. That should be a true and as accurate as we can get a picture of how much money we made. So in order to make that happen, we have accrued revenues. And I need you to remember this. I'm going to say it a lot, but you need to know the definition of accrued revenue and accrued expenses because we're going to use it a lot, especially in chapter 3. Accrued revenue. Earned, but not yet received. Accrued revenue has been earned, but it's not yet received. So all revenue is recorded as it's earned, but accrued revenue is revenue that has been earned, but not yet received. So therefore, it's in accounts receivable, right? Has been earned, but it's not yet been received. So accrued revenue is in the accounts receivable account. So in order to accrue revenue, we always increase a receivable and increase revenue account. Increase the receivable, increase the revenue account. Accrued expenses. Accrued expenses have been incurred, but not yet paid. Incurred, not yet paid. So it's going to always be an increase in expenses and an increase in liability because we record expenses as they're incurred, even if they're not paid. If they're not paid, then they're a liability, right? So accrued expenses, incurred, not yet paid. Okay. So of course, there's what goes on the income statement, revenues, expenses. The bottom line is the net income or net profit or earnings. And say sometimes it's called earnings. If the expenses exceed the revenue, it's a net loss. Okay, so it's just some terms you need to know. Statement of stockholders' equity, talked about that, talked about the balance sheet. Statement of cash flows, we'll get into this a little bit later, but has 3 different sections. So where the income statement is on accrual basis, the statement of cash flows actually converts the income statement to cash basis. So it shows us where the money came from. So for example, if I earned $100,000 in my company, but I didn't get paid yet. Maybe I finished it at the end of the month and the customer paid me at the beginning of the next month. So if you look at the income statement, I made a profit. But if you look at my bank account, I'm broke. Why is that? If I look at the statement of cash flows, I'll be able to see, yep, I earned the money, but it's in accounts receivable. So that's why we have to have the statement of cash flows to complement the income statement, because it's important for a manager to see how did we actually have a profit, but no money in the bank. So we can tell that by looking at the statement of cash flows. Also, how did we function without any money? Customers didn't pay us. Where did the money come from that financed our deficit from operations? So did it come from additional debt? Did it come from money that came from the owners? We'll be able to see all of that by looking at the statement of cash flows. Operating activities is all the money that we receive from our normal day-to-day operating activities. It could either be a plus or it could be a minus. So in the case of not getting paid for that big job, probably got a minus in operating activities. So we probably had some money from financing activities that increased our cash and helped us with that shortfall. And we'll see that from statement of cash flows. We will do some of those. Investing activities, that's where a company is buying and selling long-term assets like equipment, land, buildings, stock that they invested in other companies. So if a company is expanding, buying long-term assets, we'll be able to see that in the statement of cash flows in the investing section. And that's important to know, right? If a company is spending money on a new plant or some new equipment, that's important to know because that shows that they have confidence in the future. If they're selling off assets, that tells us a story too, right? Maybe they're having cash flow problems and they're having to sell assets in order to pay their bills. Statement of cash flows will tell us that. If they're having to borrow money or if they're issuing new stock, we'll be able to see that on the statement of cash flows. So this is a very important statement if we're trying to look at the financial condition of this company. We get to see where their money is coming from and where it's going. All right, here's an example for Levart Travel Service. There's a simple income statement, a simple statement of stockholders' equity, and a balance sheet. Okay, so notice that on the income statement, you have all your revenues and expenses, and we have a net profit or a net income. And notice the interrelation of the statements. We always did, remember, Zach, we always did the income statement first. And that was because we had to get the net profit or the net loss to carry that number to the statement of retained earnings. So we had to do the income statement first. All right, get your net profit. So there's your formula for ending retained earnings. You got your beginning plus net income minus dividends equals ending retained earnings. That is your statement of owner's equity or statement of retained earnings. Same thing. And then the balance sheet, of course, it has to balance. It lists all the assets. Total assets equals liabilities plus owner's equity, right? So how much of those assets are financed by debt or liabilities? So there's your liabilities. And how much is financed by equity? So if we look at that, we can see that the company has $177,750 in assets. How do we finance them? $12,200 is financed with equity or with debt, and the rest of it is financed with equity. Okay, so it tells a lot about a company. And of course, historical cost principle says what? Does anybody remember? Exactly. So all your fixed assets are recorded at historical cost. So if I look at this balance sheet, it says I have supplies of $3,350. I know that that's what we paid for it. The land, $90,000. I know that's what we paid for it. So I don't have to guess. Is that what it's worth? Or is that what we paid for it? Historical cost principle says that's what we paid for it. All right. And so that's verifiable. All right, and then some just throws out some ratios there, and we'll look at these a little bit, but in this class, we're pretty much studying the language of business. We're going to learn how to record transactions. So ratios are not going to be a big importance to us, but there's one: liabilities divided by total owner's equity. So what's the ratio? How much debt to equity does a company have? And of course, that's a measurement of risk. The more debt you have, the more riskier a company has or a company is, because remember, debt has to be paid back on a schedule. Equity, in contrast, does not have to be paid back on a schedule. So if you invest money into a corporation, then there's no schedule that says you have to pay a dividend at a certain time. Companies declare a dividend only when they have the money to pay it. If they don't have the money to pay it, they just don't declare it. So equity has more risk or debt has more risk than equity because it has to be paid back timely, but there are advantages to having debt as well. So if we looked at leverage, and if you took my 270 class, we talked about leverage. That is when a company uses debt in order to increase the return on their money, because what's better than making money with your money? Making money with somebody else's. So that's the use of leverage or debt in order to finance assets. You're using somebody else's money to make money off of your assets. Okay, so debt is good because it produces interest, which is tax deductible. Equity produces dividends, which is not tax deductible. So there's a tax advantage there to using debt. And plus, when you pay off debt, you've kissed those vendors goodbye, right? It's hard to get rid of stockholders, though. So as you said earlier, does the common stock ever go down? No, it's hard to get rid of stockholders. So if I issued stock in order to finance my business and I suddenly decide I don't like the other owners in the business, too bad. They own that stock forever unless they decide to sell it. Hard for me to force them to sell it. Okay, so shareholders sometimes would like to get rid of other shareholders because if I own 100 shares of stock out of 1,000, I own 10% of the company. If I can get rid of about 40 or 50% of those other shareholders, that increases my ownership percentage. Okay, so I'd like to get rid of the other shareholders if I could, but you can't pay them off. They're forever unless they decide to sell that stock. Okay, does that make sense? So if I want to just use their money for a short period of time, I want to finance with debt. Okay, so you have to weigh that. Is the company able to pay the debt back? Are they worried about cash flow? Then you're more likely to use equity if you're worried about being able to pay the debt back. But if you're looking in the long range and you can afford to pay back the debt, long range is going to be better to finance with equity. Well, in the long range, I'm sorry, it's going to be better to finance with debt because if I can pay them back, then I'm done with the use of their monies and I don't have to deal with them in the future. Anyway, okay. Some ratios. All right, so that's chapter 1. So I'd like you to work on the quiz. Let's see, we have a couple minutes. And the discussion, let's see, what does discussion say? So discuss the accounting equation. So you should know enough about the accounting equation. It says 200 words, and I had a student complain in another class, 200 words is a lot. Probably use 200 words every 10 minutes, right? Because I'm excited about this stuff. I can talk about it all day long. I hate it when my hour and 20 minutes is up and I can't talk about accounting anymore. So talk about the accounting equation. 200 words, that's nothing. So I can say the accounting equation is, so I can state that. And then I can talk about the different elements of the accounting equation: assets, liabilities, owner's equity, common stock, capital, retained earnings, revenue, expenses, dividends. I can talk about the definition of all those different elements. I can talk about the fact that the accounting equation shows that assets have to be financed with debt and equity, and that shows which one I'm using, whether I'm using debt or equity finance assets. Lots of things I can talk about. I can talk about the fact that sometimes debt's better than equity to finance, and sometimes equity's better than debt. Just depends on the situation. So I can talk all day about the accounting equation. Actually, matter of fact, I've just talked an hour and 20 minutes about it. Okay, does that make sense? And of course, the accounting equation, some people tell me that the accounting equation in their little post, they'll say it's how we measure how the company's doing. It's not. So don't say that. The accounting equation is the backbone of the income statement, the balance sheet, and statement of cash flows, but does not tell us anything about the financial condition of the company. Does that make sense? It is the backbone for those reports that tell us that, but it doesn't tell us anything about it. It's simply how we get to producing those reports that do give us that information. All right. So, but it does show us the makeup of how we finance the assets. Assets equals liabilities plus owner's equity, but that's about it. It does not tell us anything about the performance of the company. All right. So work on your discussion board and your quiz. You got plenty to do on Thursday. So as I said, I won't be here. So I'm running for best ex-wife. So I'll be taking the ex to the surgery on Thursday. And I will see you next Tuesday, if not before. Okay. So work.